To discuss China and the U.S. market, Marc Faber is back on the show today. Marc is editor and publisher of the Gloom, Doom, and Boom report and director of Marc Faber Limited. Now, I first asked Marc for his macro view on China today. Take a look at what he had to say.
Well, I've been arguing for now more than a year that the Chinese economy was decelerating much more than what analysts expected. And I think if China is growing at the present time at 4%, that's about the maximum it is growing. Having said that, China is a country with a population twice the size of the US and Europe combined. And like the US, you have different provinces. In the US, you have different states. So what can happen is that, say, in one state, there is a recession, or in one industry, there is a recession. And in other states or other provinces, the country is still growing. But very clearly, in some provinces, there is already a recession.
Now, how would someone be able to express the view that you just articulated in terms of an investment strategy?
Well, I think it's quite simple. I suppose you and your viewers and we have no clue how the world will look like in 5 years' time. This is a recognition of the fact. We just don't know. There are so many issues, and there have always been in the past so many issues that you can't predict the future. So in absence of being able to predict the future, I would recommend people to hold a diversified portfolio and not leverage too much. I have no leverage. I own my properties paid outright. I own physical gold, and I don't store the physical gold in the US. I store it outside, and I own some shares and I own some bonds. And then I go and sleep happily.
And that's what everyone wants, sleeping happily. That's the key right there. You know, Marc, China's pivot away from the economic sectors like infrastructure and housing, filled up with malinvestment, is causing a decline in commodity demand growth. And the world is flooded with industrial commodities. In fact, the Australian bank ANZ, for example, thinks we will see a record glut of iron ore that takes price down to $58 a metric ton. So what's your view on the industrial commodities space?
Well, my view is obviously first of all, my view is that the global economy is slowing down and not accelerating like the optimists in the US will claim. So that is my overall view, and also the bulk of the incremental demand for commodities in the last 15 years came from China. Say, for industrial commodities, China went from 12% of global consumption to 47% of global consumption. So that lifted commodity prices dramatically. Plus, there was money printing that also contributed to the rise in industrial commodities. Now, this is not there anymore. As I pointed out, Chinese growth at very best, and there could be a bust, but at very best will slow down, or has slowed down to around 4%. I think it's even slower than that. But the point is, yes, industrial commodities will go down for a while, and then they'll stabilize and again go up, because I'm involved in mining. As a director of mining companies, I can see that the cost of mining has gone up dramatically.
Now, like you said, you know, the U.S. market, it's very expensive, and the S&P 500 trades at 17.6 times trailing earnings right now, and this is despite a decline in earnings growth. So how do you see the U.S. market doing in 2015?
I have to laugh. Who knows what the earnings are? They're like the statistics published by the U.S. government. They're probably all doctored. So maybe on a normalized basis, the S&P PE is maybe much higher. All I know, and this is a relatively valuable measure of valuation, is the price to sales of the S&P 500 is at the highest level ever. Highest level ever. And sales are less doctored than earnings.
Wow. I mean, that's something to think about. You know, I noticed recently that we're now seeing the largest percentage of companies coming to the market with no earnings since the dot-com days. But actually, unlike back then, the companies are not all tech. It's biotech companies, you know, pharmaceuticals that are, you know, a big hit there. So why are people piling into stocks with no earnings, Mark? Why is that?
Look, a mania, a bubble is a bubble. People don't buy things because they have value. They buy things, stocks, because they think they'll go up. So if I'm a speculator, what do I care about the valuation of a stock? If I think tomorrow it will go up, I'll buy it. And hedge funds do the same. I'm not saying that this is the strategy I would recommend for wealth preservation. And I think we are today in a situation where investors should think first, how do I not lose money? And only in the second place, how will I make money? Because the valuations argue against making a lot of money for the next 10 years, whether it's in bonds or in equity. Say you buy a 10-year US Treasury, the maximum you will earn is slightly below 2% per year. That's 2% per year. That is the maximum you will earn. The stock market, it may go up another 5–10% here, maybe even 20%. But afterwards, it drops 50%. The damage will be colossal.
Now, JP Morgan noted a week ago that globally, $3.6 trillion of bonds carry a negative yield, and that number is rising. Countries in Europe, in fact, they're even issuing paper with a negative yield at auction. That seems insane to me, no?
Well, please write a letter to the Federal Reserve and to other central banks and tell them it's not my mistake, you understand? I agree with you, but this is what the professors and the academics at central banks have done. That's precisely what they've done. And it will lead to a complete disaster. That's what I'm saying. You have to at some point short central banks because they have no clue what they're doing. Say, an insurance company, they have premium incomes, but they also have significant investment income, okay? So with rates at this level, they will have to increase premiums significantly or cut benefits.